Hello, everyone. Today I will talk to you, my valued viewers, about the 1973 stock market crash. Enjoy the video. The 1973 stock market crash, how the markets the world trusted fell apart. By the time 1973 arrived, most people believed the economy was doing just fine. Stock markets had been rising for years, companies were growing, and investors were making more and more money. For many people at the time, buying stocks seemed like an almost guaranteed way to make money. The idea that the market will eventually rise again anyway was incredibly common. But history has shown us the same thing over and over again. The biggest crises always begin knocking at the door at the very moment people believe everything is going perfectly, and it has always been this way. That is exactly how the 1973 stock market crash began. The interesting part is that this crisis didn't happen in a single morning. It wasn't over in one day like the stock market crashes headlines you see in newspapers. The real danger unfolded much more quietly. First came small declines. Then investors said, "This is temporary." After that, selling accelerated. And in the end, millions of people lost more than half of the wealth they had built just months earlier. This is where human psychology comes into play. When markets are rising, people ignore the risks because everyone is making money. But once the decline begins, those same people start following each other into selling. One person sells, then 10 more follow. Then hundreds, then thousands of investors do exactly the same thing. This is exactly where what we call panic begins. As 1973 began, cracks had already started to appear in the economy. Inflation was rising, central banks were increasing interest rates, companies were facing higher costs. Yet the stock market still wasn't taking these problems seriously enough. Or perhaps it simply didn't want to. Then one of the biggest events of the year took place. Following the outbreak of war in the Middle East, Arab oil producers imposed an oil embargo on the United States and several Western countries. Almost overnight, the global oil supply tightened dramatically. Oil prices began multiplying within just a few months. Even today, whenever oil prices rise, you see it all over the news. That's because oil isn't just fuel for cars. Trucks run on oil. Ships run on oil. Airplanes depend on it. Factories need energy to operate. Agricultural machinery consumes fuel to work, and that also creates demand for oil. So when oil becomes more expensive, almost everything becomes more expensive. And that's exactly what happened. Production costs for businesses increased, transportation became more expensive. Prices in supermarkets started climbing. Inflation accelerated even further. For the first time, investors became seriously worried. They believed companies would earn less profit in the future. And if a company is expected to make less money, why should its stock remain at the same value? That was one of the biggest reasons selling started to accelerate. But oil wasn't the only problem. At the same time, central banks were raising interest rates in an attempt to bring inflation under control. When interest rates rise, borrowing becomes more difficult for businesses. People begin spending less. Investments slow down. The economy was being hit from several different directions at once. High oil prices, high inflation, high interest rates, a slowing economy. And all of these were happening at the same time. This was exactly what economists today call stagflation. Normally, you either experience rising inflation or a slowing economy. Having both at the same time is extremely rare. But in 1973, the world experienced exactly that. The stock market began pricing in this reality. Share prices kept falling for months. With every decline, people thought, this has to be the bottom. The market kept falling little by little. Then once again, people said, this is the final drop. And it fell again. One of the biggest mistakes people make is believing that major crises end within a few days. In reality, large financial crises usually unfold slowly. First comes hope, then denial, then fear, and finally panic selling takes over. What happened between 1973 and 1974 is clear proof of that. During this nearly 2-year period, the S&P 500, one of the United States' most important stock market indexes, lost nearly half of its value. Just imagine for a moment, if you had invested $200,000, nearly $100,000 of it would have disappeared. And not in a matter of weeks. It would have slowly melted away. day after day, over the course of many months. It's hard to imagine a more difficult experience for the human mind. Some investors accepted their losses and sold. Others waited, believing it'll come back eventually. And some panicked and sold right at the bottom. If you look throughout history, you'll notice the same pattern in almost every major stock market crash. People become overly optimistic during bull markets. Then they become overly pessimistic during downturns. But markets don't move because of people's emotions. They move because of expectations. The 1973 stock market crash taught investors an incredibly important lesson. The economy isn't driven by just one indicator. Oil prices, inflation, interest rates, geopolitical developments, corporate profits, consumer confidence, they're all connected, like the links in a chain. When one link breaks, the others begin to shake and slowly break apart as well. The 1973 crisis was a perfect example of that. The oil crisis started in the energy market, but its effects didn't stay at the gas station. It pushed inflation higher. It forced interest rates upward. It increased business costs. It slowed economic growth. And eventually it shook the stock markets as well. Even today, investors continue to study the 1973 crisis because it is considered one of the most important turning points in modern financial history. The biggest lesson to take away from this is, stock markets don't simply price today's reality. They price expectations about the future. And when people lose confidence in the future, even the strongest looking markets can begin falling much faster than anyone expects.